Hello and welcome to CMC Markets on Tuesday the 1st of October and the weekly market update and the beginning of Q4. Now, we've had a fairly positive quarter for stocks in Q3. We also had a positive month for stocks in Q3. And when you consider some of the political backdrop to the current equity market rally, that in itself is by no, it's no mean feat. Having said that, we have come off the back of a negative week for stocks, on the back of that old favourite political dysfunction, not only in Italy, Europe, but also in the United States of America. And we are now in the process of another US government shutdown. It's not the first time this has happened. It's probably not going to be the last. And we are seeing a little bit of a small bounce in equity markets today on the back of what I would suggest is a little bit of probably complacency on the part of investors with respect to a possible solution or an imminent solution in the next few days. Nevertheless, we have to be prepared for the fact that we could actually see the non-farm payrolls data postponed if the current shutdown actually starts to stretch into more than 2 or 3 days. I think the bigger problem going forward is the problem of the debt ceiling. Now there doesn't have to be any agreement on that until the 17th of October. So I think any government shutdown for the time being, the market's pretty much going to take it in its stride. I think if it continues to go on into next week or even the week after, then you could start to see the markets get a little bit twitchy. And I think that really has been borne out today in the gold price. The gold price, somewhat counterintuitively, given the political dysfunction, not only in Europe, but also in the US, has actually come off quite aggressively. So we'll start with the daily gold chart, and we can see from the chart on the screen right now that we've just broken a trendline support from the lows in June. We've just broken below that. The next key level is the September lows around about the 1273 mark. Now we can see from the trend line that's coming in from the 26th of August highs that we initially tried to break higher around about the 1345 level on the Monday. Since then, we've been unable to do that, and rather counterintuitively, given the political uncertainty that's going on right now, certainly with respect to the US, we've come down quite aggressively. Now, I'm not going to be overly concerned about the current decline in the gold price until such times as we take out that 1273 level, which has acted as support since the lows that it put in September. If we do break below that, then obviously we could well see further declines going forward back towards the June lows that we saw around about the 1180 level. So let's move on to the euro. When I think one of the things that has really surprised me over the past few weeks is how resilient the euro's been. Because when you consider all the bad news, all the uncertainty about the German elections and the continued uncertainty with respect to the German elections, because at the moment Mrs. Merkel hasn't formed a coalition and doesn't look as if she's likely to anytime soon. We've seen some disappointing PMI data this morning from the manufacturing sector. It's still very much in expansion territory, but it didn't expect the PMIs didn't expand anywhere near as much as economists had expected that they would do. And I think that is a major concern. We've also got rising unemployment still in Italy, also in Spain, particularly amongst the 15 to 25 age bracket, and I think that's a real concern going forward. Having said that, the resilience of the euro, can it last? Well, let's look at a couple of charts. Let's look at euro sterling because it's been anything but resilient there. But first and foremost, let's look at euro Aussie because it's been extremely resilient there. So we're going to look at the euro Aussie chart, and we can see from this daily chart that it has formed somewhat of a double top, and there is an expectation now that maybe we've seen the highs in euro Aussie. At the moment, we're currently coming back to retest the breakout level, the breakout resistance, but as long as we stay below that particular resistance level, then I think the likelihood of further weakness in euro Aussie remains the preferred outcome. And pretty much I base that on the back of the fact that the Australian dollar is more likely to outperform the euro than anything else, rather than we expect to see significant euro strength going forward. That's not to say, however, that we can't see 137.10 in euro dollar, which is this year's highs. as long as we break above the 136 area in the euro dollar. And I think that's a real key level there. I talked in my blog earlier this week about a potential double top between 135.70 and 135.80 on euro dollar. If we break above there, then obviously that becomes completely negated, and we're looking at retesting the 137.10 area, 137.15 area that we saw earlier this year. Which brings me neatly on to euro sterling. Now, euro sterling has been in a downtrend for quite some time, and I think the direction of travel there still remains firmly to the downside. However, as with euro sterling and any other euro currency, we have to be prepared for short squeezes, and at the moment I still think that we can reach 82.80, which is that key 50% retracement level from the 77.50 lows to the highs that we saw earlier this year. But how we get there is going to be, I think, a little bit more tricky to predict. The downtrend that's currently on the chart that you can see in front of you comes in around about 84.10. So I wouldn't rule out a move back to that particular level. But as long as we stay below 84.20, then I think it's much more likely that we could see a move to 82.80 than we could see a move back to 85. Which brings me on to cable. That's been a significant outperformer over the past few months. I don't think anyone could have predicted that when we were trading at 148 earlier this year that we'd be back above 162 in October. But that is essentially where we are. Economic data from the UK continues to come in on the more positive side of things. Manufacturing PMI came in slightly below expectations this morning, but the employment component came in at the highest level since May 2000, around about 2011. I think it was March 2011, which is a good thing, certainly in the context of a falling unemployment rate. So going forward, I think there's a good chance that we could revisit the highs that we saw earlier this year above the 163 area. 163 is the initial target, but we could actually go as far as 163.70, which was the highs that we saw in January. So that's pretty much it for this week. Quite a lot to get through, I know. We will be hosting our non-farm payrolls webinar on Friday, irrespective of whether the data is released or not. If the data is not released, what I'll do essentially is basically summarize the events of this week. So feel free to sign up, irrespective of whether the payrolls data is released or not. In the meantime, thanks very much for listening. This is Michael Houston talking to you from CMC Markets.